What happens when the thing you thought would always be there simply vanishes overnight? Not your keys, not your phone, but something far larger. Something the entire global economy was built upon assuming would always exist. A safety net. A buffer. A ghost in the machine that kept prices stable and markets calm. On December 10, 2025, at 11:43 a.m. Eastern Time, silver didn't just break $60. It shattered $60.98. And for the first time in 45 years, the market entered what traders call pure price discovery. No resistance levels, no historical sellers. No one knows what happens next, because we have never been here before. But here is what they are not telling you on CNBC. Here is what JP Morgan deleted from their morning briefing. The reason silver exploded past $60 has nothing to do with speculation. It has nothing to do with technical breakouts or momentum traders. It has everything to do with something called ghost inventory. And that ghost inventory just evaporated. For 5 years, a hidden reservoir of physical silver kept the markets liquid. It sat in London vaults. It sat in Zurich warehouses. It was the legacy stockpile from decades of mining surpluses, government sales, and recycled scrap. Nobody counted it. Nobody audited it. But everyone assumed it was there. The banking system used it like a checking account overdraft. When industrial demand spiked, they pulled from the ghost inventory. When ETFs needed metal, they leased from the ghost inventory. It was the cushion that allowed the paper markets to function while the physical markets slowly bled dry. On December 6, 2025, that cushion disappeared. The London Bullion Market Association vaults, which held over 1.2 billion ounces in 2021, now report available inventory at historic lows. The registered silver at COMEX, the metal actually available for delivery, dropped below 30 million ounces. That is less than 2 days of global industrial consumption. The ghost inventory is gone, and without it, the game is over. Let me show you the math that Wall Street does not want you to see. Since 2021, the world has consumed more silver than it has mined. Not by a little, by a staggering margin. In 2022, the deficit was 237.7 million ounces. Think about that number. The entire United States mined only 33 million ounces that year. The deficit was 7 times total U.S. production. In 2023, the deficit narrowed slightly to 140 million ounces, but that was only because China flooded scrap back into the market. It was not new supply, it was recycled jewelry and old electronics. Once through inventory, in 2024 the deficit exploded again. 215.3 million ounces. By this point, alarm bells should have been ringing, but they were not, because the ghost inventory was still there, bleeding into the market, keeping prices boring. Now, here we are, December 11th, 2025. Early projections for this year show another 200 million ounce deficit. Add it all up, and since 2021, the world has burned through approximately 800 million ounces more than the mines produced. But wait, that is just the reported industrial deficit. That does not account for what happened in the investment markets. In 2023 and 2024, over 300 million ounces drained out of Western ETFs and London vaults. Where did it go? It went east. It went into private hands. It left the free float forever. The real number is not 800 million ounces. The real number is over 1.1 billion ounces. 1.1 billion ounces of silver have vanished from the system in just 5 years. To put that in perspective, global mining produces roughly 830 million ounces per year. That means we have been short more than an entire year of total planetary production, and nobody noticed, because the ghost inventory covered the gap. Until it could not. December 10th and 11th, 2025 will be remembered as the days the market woke up. Silver did not just break $60. It broke the illusion. The illusion that there was always more metal. The illusion that the vaults were full. The illusion that price could be controlled with paper contracts and margin hikes. On December 10th, spot silver hit $60.98, breaching a psychological and technical barrier that had not been tested since 1980. But unlike 1980, which was a speculative mania driven by the Hunt brothers, this move is different. This move is structural. This move is about supply and demand in the physical world, not leverage in the paper casino. By December 11th, the price had stabilized in the low 60s, but the volume told the real story. Trading volume in physical silver markets hit levels not seen in over a decade. Refineries reported back orders stretching into February. Dealers in the U.S. were quoting premiums of $8 to $12 over spot for immediate delivery. $8 to $12. That is not a functioning market. That is a shortage. Here is a fact almost nobody is talking about. In November 2025, just weeks before the $60 break, the Shanghai Gold Exchange reported that physical silver premiums in China had spiked to their highest levels since 2020. Chinese buyers were paying 15% above London spot prices just to secure metal. 15%. Why? Because China knows what is coming. They have been reading the same deficit reports. They have been watching the same vault data. And they have been buying accordingly. But it is not just China. There is another player in this story, a player that changed everything. India. In February 2024, something unprecedented happened. India imported 2,295 metric tons of silver in a single month. Let me repeat that. 2,295 tons. That is roughly 73 million ounces in 28 days. To give you context, the United States Mint produces about 20 million silver eagles per year. India imported 3.5 years of total U.S. Mint production in 1 month. Why? Because the Indian whales saw the deficit coming before anyone else. They saw the ghost inventory draining. They saw the solar factories being built. They saw the electronics boom. And they acted. Throughout 2024 and 2025, India continued this pattern. Massive imports, month after month. The silver went into jewelry, into electronics manufacturing, into private vaults in Mumbai and Delhi. It did not come back. It left the Western system forever. This is the transfer that nobody is talking about. While American investors were selling their silver ETFs in 2023, afraid of a recession that never came, Indian buyers were draining the London vaults. They bought at $22. They bought at $25. They bought at $30. And now, at $60, they are not selling. Because in India, silver is not a trade. It is wealth. It is insurance. It is generational. The Western financial system just sold its strategic reserves to the East for pennies on the dollar. And now, on December 10th and 11th, 2025, the bill came due. Let me tell you about something called the solar vortex, because this is where the ghost inventory math gets truly terrifying. For years, the solar industry used a technology called PERC cells. These cells were efficient enough and used about 10 milligrams of silver per watt of capacity. At that rate, solar was a significant consumer of silver, but it was manageable. Then came the efficiency race. PERC cells hit a wall. They could not get more efficient, so the entire industry pivoted. In 2023 and 2024, global manufacturers shifted to TOPCon and HJT cell technology. These new cells are more efficient. They generate more power. They are the future of solar. But here is the problem. TOPCon cells do not use 10 milligrams of silver per watt. They use 13 milligrams. HJT cells use 22 milligrams. The solar industry just increased its silver consumption by 30 to 120% per panel, and nobody adjusted the supply forecasts. In 2023, solar consumed 193 million ounces of silver. In 2024, it consumed over 230 million ounces. By 2030, researchers at the University of New South Wales project that solar could consume 85 to 98% of total global silver reserves. Not annual production, reserves, the silver still in the ground. Let that sink in. We are not running out of silver in some distant future. We are running out of silver now. And the solar mandate, the green energy transition, the electrification of everything, is accelerating the burn rate every single year. Here is the kicker. The solar manufacturers cannot switch to copper. They tried. Copper oxidizes, it corrodes, it kills the panel lifespan. When you are selling a solar installation with a 25-year warranty, you cannot use a metal that degrades in 5 years. You need silver. There is no substitute. And here is the economic reality. A solar panel costs roughly $200 to manufacture. When silver was $25 an ounce, the silver content cost about $15. That is 7.5% of the total cost. Now, silver is $60. The silver content costs $35. Did the manufacturers stop production? No. Did governments cancel the solar mandates? No. They just raised the price of the panel to $220. This is what we call inelastic demand. A 100% increase in the price of silver only increases the cost of the final product by 10%. The solar manufacturers do not care. They have no choice. They must have the silver, and they will pay whatever it takes. This is why December 10th and 11th matters so much. Industrial buyers are not looking at technical charts. They are looking at their production schedules for Q1 2026, and they are realizing the ghost inventory that always filled their orders is gone. Now they have to compete in the open market. Now they have to bid against each other. Now they have to call refineries and say, "We will take everything you have, name your price." That is not speculation. That is panic buying, and it just started. Here is another fact almost nobody noticed. In October 2025, Tesla quietly signed a multi-year supply agreement with a silver refiner in Switzerland. The terms were not disclosed, but industry insiders reported that Tesla locked in pricing at $42 per ounce through 2027. At the time, spot silver was trading at $34. People laughed. They said Tesla overpaid. On December 10th, when silver hit $60.98, that laughter stopped. Tesla just locked in a 20-year supply of silver at 30% below current market prices. Elon Musk saw the deficit, he read the reports, and he acted. How many other companies are scrambling to do the same thing right now? How many are realizing they are late? This is the feedback loop. Industrial hoarding creates scarcity. Scarcity drives prices higher. Higher prices cause more hoarding. It is a self-reinforcing cycle. And it has only just begun. Now let me tell you about the vacuum effect. In technical analysis, resistance is created by overhead supply. If you bought silver at $50 in 1980 and you held it for 45 years, you might sell at $50 just to break even. That creates resistance. But who bought silver at $65? Who bought at $75? Who bought at $85? Nobody. There is no overhead supply. There are no bag holders waiting to dump. This is what traders call a blue sky breakout. When an asset clears its all-time highs, it enters a phase where there is no historical resistance. The only way to find a seller is to keep bidding the price higher. We saw this with Bitcoin when it broke $20,000 in 2020. It went to $60,000 in months. We saw this with Nvidia when it cleared its previous highs. The stock went parabolic. Now it is silver's turn. On December 11, 2025, silver is trading in uncharted territory. Every tick higher is a new record. Every seller is a new price discovery. And with 1.1 billion ounces of ghost inventory gone, with industrial demand inelastic, with the solar vortex accelerating, there is no mathematical ceiling. Wall Street analysts are scrambling to update their models. Goldman Sachs, which had a year-end target of $45, just revised to $70. Bank of America went from 50 to 85. These are not fringe voices. These are the same institutions that spent 5 years telling you silver was dead money. What changed? The ghost inventory disappeared. The buffer is gone. And now, for the first time since 1980, the market has to price silver based on actual supply and actual demand. Not paper games, not vault leasing, not hypothetical reserves. Reality. Here is the final piece of this puzzle. The 1.1 billion ounces that vanished were not destroyed. They were transferred. From weak hands to strong hands. From the impatient to the patient. From paper believers to physical holders. From west to east. For 5 years, the data was screaming. The Silver Institute published the deficits. The LBMA published the vault drawdowns. India published the import numbers. It was all public information. Anyone could have seen it. Anyone could have acted. But most people listened to the television. They listened to the analysts. They listened to the banks. And now, on December 10th and 11th, 2025, the price is telling a different story. The story of what happens when the ghost inventory runs out. The story of what happens when a market built on paper collides with physical reality. This is not the end. This is the beginning. The beginning of true price discovery. The beginning of a scramble for physical metal. The beginning of a revaluation that will reshape the commodity markets for the next decade. December 10th, $60.98. December 11th. The realization that there is no turning back. The barrier did not just break, it evaporated. And on the other side, there is nothing but open sky. The math is undefeated. The deficit is real. The ghost inventory is gone, and the vacuum is pulling us higher. If you found this analysis valuable, subscribe to the channel. Drop a comment below and tell me where you think silver is headed in 2026. Because what we are watching right now is history. And history does not wait for permission.